Let's now look at the Ask Weekend Investing round number 48. Uh, Before we move ahead, please do like and share these videos if you like the content, and do subscribe to the channel. We've done 47 rounds of this Q&A prior to today, and 769 queries have been answered. I would recommend that you go through these videos and enhance your knowledge about various subjects that have been discussed here. Shaukat Ali has the first question. Can we please compare HNI strategies and non-HNI strategies to understand how HNI small case preserve wealth, and also discuss how liquidity can be a problem for non-HNI small cases? See, these strategies are designed for the purpose that they are being offered. So, for instance, in non-HNI strategies, we are not expecting large amounts of uh, per order value and volume to come through. Whereas in HNI strategies, we are expecting people to put in a lot more money. So per script, a larger order will go into the market. Number two, for HNI strategies, we allow larger amounts of priced stocks to be in the strategy. For instance, in a non-HNI strategy, we will never have a stock which is more than, let's say, 10,000 rupees. Because as soon as you allow, let's say, a 25,000 rupee stock, and even if you have to buy one stock of that, and if that stock has an allocation of, let's say, 3% or 5%, then your minimum requirement for that non-HNI small case, the minimum capital requirement goes up in a very big way. So there are many such nuances. It is mostly to do with liquidity and how liquidity can be addressed for each segment of the strategy. Saurabh says during a structural correction, if every sector is going down equally, except for say one defensive sector like FMCG, can we assume that all momentum strategies will fully align with FMCG in this case? Will we ever see 100% allocation within only one sector for momentum strategies? Just want to know if this is possible. So yes, it is possible, but it has not happened in the cases that we have studied over the last many decades. I mean, there are always multiple sectors that are, so usually defensive sectors would be not just FMCG, but pharma, perhaps even IT, perhaps even the healthcare space. So many of these sectors tend to move together. But yes, I mean, if there is an extreme situation where, let's say, like a dot com year 2000 situation where perhaps 80% of the stocks were from IT and telecom, yes, then that kind of allocation can come through. Pratyush says, if I remember correctly, in years 20 to 23, you used to show the weekly, monthly, and year-to-date percentage increase, decrease figures of all weekend investing strategies. Why has this been discontinued? Because the regulator has asked all SEBI registered intermediaries to stop doing that. Rajesh says, I want to be able to invest across different styles of investing with various fund managers like growth, quality, fundamental, momentum, contra, dividend, ESG, etc. But a major challenge that I'm facing is that I'm not able to gather a base mindset. Sometimes you are exiting a losing stock in momentum, but at the same time, you are expecting to average that. Is it necessary to have different styles if one is convinced about just one style? So, the question A that you are asking, the answer is no, it is not necessary to have different styles. I can give you my own example. I only run momentum for myself. And B, if yes, how does one build the required mindset? So, the required mindset can be built by not having distractions of different styles to start with, and starting to have conviction in the style that you're following. Let's say you're following the value style, then you forget about everything else and just focus on value and develop that mindset. If you are, let's say, want to do only momentum, then you can forget about everything else and look at what has momentum done in the last 20 years. Those who followed momentum, how have they fared? What are the pluses and minuses of each style? Do they fit your personality, in the sense of your being able to accept that style? A lot of folks are very happy to buy as stocks come down and sit in losses. That is natural for some folks. For other folks, that is a major challenge. For myself, I can tell you it was a major challenge for me to see myself sitting in losses for years together, not knowing what will happen. I could not accept it. I only want to be in stocks where it is visually uh, confirming to me that yes, I am on the right path. Your stock is going down, I'm buying. It is not confirming to me that my buying is being successful. Maybe at some later stage it may, but for that period, I am, burning like hell. And why should my investing journey be so, self-defeating? I want it to be a positive experience. I want it to be a happy experience. I don't want my investing to, over encompass my behavior where, I'm all the time in the back of my mind thinking that, I bought that stock at 100, it is now 20 rupees. What should I do? I don't want to be doing that. So again, it depends about your conviction. Build a conviction. Uh, See how different styles have reacted to various, and there is enough data available for various strategies, various styles, how they have performed in India, elsewhere, which is that style which has beaten all other styles. You can get all that data, and once you're able to see that, you'll be able to build that mindset. It will take time. I mean, nothing happens overnight. Andrew says, in terms of absolute safety and peace of mind, can we assume only physical gold can give that? Yes, you are right. What happens to my gold ETFs if a nation crumbles due to war, for instance? Let's say, I mean, I don't even want to say it hypothetically, but let's say we were living in some XYZ country which was war ridden, and a huge conflict happens. Then all the promises made by the financial institutions of that nation will basically come to a naught. So if you are holding certain electronic, uh, you know, credit with some bank or some demat account or some uh, safekeeping of whatever digital asset, those companies will not exist anymore, perhaps. So everything will be restarted, sort of. It is almost like saying that unless you are not holding physical gold, it is not yours. Even like when you keep your money in the bank, it's actually not your money. It is the bank's money at that point of time. And you are getting an interest. You have loaned your money to the bank, and the bank is paying you an interest. We have a mentally a thought process that the bank will never default on me, and hence we think that it is my money which is sitting there. It is actually you have loaned your cash to the bank is giving you a return for that loan, and the loan could be defaulted. Any loan can be defaulted, but we don't think in that way because government says we will assure you that we will pay you up to 15 lakhs, so on and so forth. And so you get the gist of things, right? I mean, if you have it, it's yours. If you don't have it, it's a IOU, and hopefully that IOU works. Ali says, can we consider adding 10-15% stop loss for evergreen stocks on the day of purchase to limit potential drawdowns during the month? For instance, if a defense stocks drops sharply, we currently have to wait until the month end rebalance. Do you think implementing this would make a meaningful difference, or is it not worth it? In my view, it is not worth it. The whole idea of these strategies is that you invest and you then live your life for 1 month without bothering about it. And then you come back after 1 month, do the rebalance, and then live your life again for 1 month. That is the whole purpose. And that at the end of 5 years, hopefully, you have some meaningful returns to enjoy. The idea is not that you enter a long term strategy which has a monthly rebalance and get glued to the screen and watch each and every tick. So, from my point of view, don't do this. If it gives you enormous comfort, then it's up to you. Nagendra says, what is the prediction for gold, sir? Will Nifty touch 21,500 and then rally towards 30,000? I wish I could tell you what gold or Nifty would do, but I really can't. I have no way of predicting things. And I can tell you that 99% of the predictions in the market are just for time pass. Don't worry about any prediction. If you ask my view on is gold likely to go up in the next few years? Yes, I think so. Is Nifty likely to go up towards 30,000? Yes, I think so. Whether it will touch 21,500 and then rally, nobody can say. But the way things are going right now, 21,500 is as far from the current price as 30,000 is. So perhaps 30,000 is nearer. But I really can't predict. And I don't want to predict also. I mean, though once you start to predict things, you basically color your mind towards that position. So for gold, I would say start to look at it as an allocation. Forget about what price gold is. Don't worry about whether it's 3,500, 3,000, 2,500, 4,000. Forget about that price. That is only for some enjoyment that you may get. The real thing is that it is ensuring your life and your assets come what may, and that is the whole purpose of it. So you have to accumulate gold and make sure that you come to a reasonable allocation to gold. Forget about the price. Gold has 5,000 years of history to tell you that it will protect you. Believe that history. Karthik says, I really like MI35. Thank you very much. And my current value is near the upper limit of the recommended capital. I was told that one should rotate money out of the strategy, but I strongly feel this interrupts compounding in a major way. Why am I being asked to do this? How to solve this? So, nobody probably is asking you to remove capital from here. You can continue to run it. If your capital goes way beyond what is being recommended, it is for your own safety that we don't want larger orders to come to the market, because the small case system is built in such a way it sends market orders into the system. There are no limit orders. And hence, if as your portfolio becomes larger and larger, the each order that will go in the market can cause slippages. It may cause slippages in the price, or you may be the only one who may get the slippage and others may not. So your performance may start to deviate from the model performance. So hence, and even in general, if your pie is getting larger, you don't want to be just focused only on one strategy in small caps. You want to diversify as well. That is the general recommendation. Alok Khandelwal says, how to understand if stock has lost momentum versus temporary dips to avoid selling with small gains, as stocks may turn into multi-bagger, as Alok keeps on explaining in many of his videos. So there is no one metric for this lost momentum. It again, like for example, a company has a book value of 10 rupees. It is trading at perhaps 12 rupees. So, it is very near book value. But if it comes to 11, it is nearer to book value. At 10, it is equivalent to book value. At 5, it is below book value. So, it depends how you will measure momentum. For instance, if you are going to measure momentum, that what has been the price change in the last 1 year, if that is perhaps negative, yes, momentum is lost. Perhaps longer term, if 12-month change is positive, you can consider it to be having momentum still. Perhaps the momentum strategy is such that it looks more short term, maybe 3 months. So in the last 3 months, if the stock is not going up, perhaps it has lost momentum. There may be others who may look at momentum on a weekly basis. So again, there is no one way to define momentum. Momentum is just one tool, and the metric of it will be dependent upon the strategy that you are keeping. So, for instance, strategies that we have which have monthly rebalance, we will allow longer term momentum calculations for those strategies. Strategies that have shorter term rebalances, we will allow shorter term rebalance, momentum look back for those strategies. So, it again depends upon the uh, strategy. Anshuman says, can you offer some brief thoughts on your product pipeline so that I can plan my investments accordingly? I heard of some AIFs in the working. You spoke about US momentum strategy also. What small case products can we expect from your side in the next couple of years? So in 2025, you should hopefully see the AIF getting launched. You should hopefully see the US strategy also getting launched. And you may will also perhaps see more small case products getting launched. That's all I can say for now. Oh, we're at the end of the Ask Weekend Investing round for today. So thank you so much for your queries. If I've not been able to take up your queries, I will certainly do that in the next time. If there is any burning issue that you want answered, please drop us a mail at support@weekendinvesting.com and it will get answered. All the previous episodes are here in the description. Link is there. Please go through them. A lot of learning in general about markets is available on our channel. Do subscribe to our channel. Do like and share these videos and do share it with your friends and family. Thank you so much. Have a great weekend. I'll see you in the next one. Bye.